can't wrap my head around the recent 10-for-1 split on Nvidia. So we'll talk the old price terms, right? I bought it at I highlighted it for my subscribers at 175 2 years ago. Went up to 1,200 and change. But my first target was 475. I sold a little. Next target 675. Sold a little. Next target 900. Sold a little. Next target 1,200. Sold a little. My current target is 1575, or I guess now that it has split 10-for-1, that would be 157. We'll call it 160. And here's what's so amazing about NVIDIA. Yes, the stock has run up dramatically, but so have the earnings. 4 years ago, the company earned $2. This year, they'll earn $30, right? I mean, it's like 350% growth annually for 4 years. That won't last forever.
Hi, and welcome to Wealthion. I'm James Conner, and today my guest is Adam Johnson. And Adam is a former oil trader, a former host on Bloomberg television, and now he's a portfolio manager of the Bullseye American Ingenuity Fund. Adam, thank you very much for joining us today. How are things in New York?
Oh, it's going well, Jimmy. I sort of feel like it's a September morning. 60 degrees at 7 a.m. You go get a workout. It's 80 by 2 o'clock, and we got a bull market right now, so I feel good.
That is the perfect weather. So you have a very interesting background, and why don't you just give us a brief overview of your background and how you got to where you are now as a portfolio manager?
Oh, you bet. Economics major out of Princeton. The irony is I actually thought I was going to be a doctor, and my Econ 101 prof was Alan Blinder, former vice chairman of the Fed. And he said, you're the only one who comes up to me every day after class and asks questions. So he said, I think you should be an economics major. And I took his advice, and I'm glad I did, because it's been a great journey. And, you and I are both Wall Street guys, and it's just a never-ending narrative. It's always changing, right? You're trying to solve crossword puzzles before the clues change. So I went to Merrill Lynch right out of college, worked in the 2-year analyst program. From there, went to Louis Dreyfus, learned how to trade oil, traded jet fuel in the Gulf Wars, the first one in particular, and loved that. But I felt like oil was too narrow a focus. So made the jump over to equities and options, and did that for a number of years at a wonderful firm called Firm & Sells. We sold ourselves eventually. I started going on TV, Bloomberg, Fox Business, CNBC, kind of 07, 08, 09. And in 09, Bloomberg asked me to join full-time as a TV guy. I never meant to do it, but they had said, we're just journalists. We need some guys who've actually been in the trenches doing it. And I learned a ton, but missed the street. So left Bloomberg in 2016 and launched my investment letter, Bullseye Brief, which has given birth to the money management business. I run the Bullseye American Ingenuity Fund, and here we are today. So, it's funny because if you look at each one of those steps, they're very different, and you wouldn't necessarily say back in 88 when I graduated, oh, well, that means that in 2024, Adam's going to be there. And yet when you hear about the story, it's actually a pretty logical sort of one thing led to another kind of journey. And I think that's true of life, right? You can't predict where you're going to be, but if you look back retroactively, a lot of times things actually make more sense than they do in the moment.
That's a fascinating background, and I do want to pick your brain about being an oil trader. But before we do that, why don't we just start off with the American Ingenuity portfolio and just tell us about this fund and what the mandate of the fund is.
Sure. Well, I originally set out to celebrate, and I use that term carefully, celebrate American ingenuity, the people, companies, and technologies driving the world forward. And as I started to explore that celebration, it became pretty apparent to me that if something were actionable, it would mean more to my readers. In other words, okay, fine. So you like this technology. What's a stock that exemplifies this technology? Tell me about the management team of this company. So I very quickly figured out I needed to make it actionable. And as a result, the portfolio is built around largely technological driven innovation, but it's not entirely a technology fund. So yes, I've got the obvious ones, the Magnificent Seven, of course, because I call that core ingenuity. But yes, and I have artificial intelligence because that's the most transformative movement of the moment, just as cloud was a few years ago, as e-commerce was a few years before that, but also robotics. I think that's very exciting, and all the industrial companies incorporating robotics into their production to cut costs, be more productive, et cetera. So I like these big themes. We talk about oil. The problem with oil, even though I love it and I love talking about oil, is oil companies are price takers. They have to take what the market will give them. And I prefer price makers, a company like, to pick an obvious one, NVIDIA, that's creating these new chips, and they set the price. They are price makers. And companies that are price makers are generally more interesting to me because they're in control. And so they have more pricing power. They have more distribution power. And it's just ultimately, I think, a more interesting, long-term, and profitable way to invest.
And Adam, how would you describe your investment approach? Are you a top down or bottoms up guy, or are you a growth guy or a momentum
Well,
guy?
I'm absolutely a growth guy, but there's always room for value. And I'm definitely a bottoms up guy, but there's always room for top down analysis. In other words, so I mentioned that I was at this one firm, Firm Cells, after I left Louis Dreyfus, where I traded oil. And I was there for, gosh, 13, 14 years, loved it. And my boss and mentor, wonderful man who used to interview everyone and ask the same question. And the question that got you the job was, how do you make the most amount of money on Wall Street? The answer he wanted to hear, and the answer that got you the job, was find a theme and leverage it. So that's why I say there's always room for top down. So, you say, well, what's the most important theme of the moment? Artificial intelligence. I think it's almost self-apparent, right? And then you say, okay, fine, artificial intelligence, I get it. So how do we represent that? I hate to say play that because that sounds kind of cavalier, but how do we represent that in the portfolio? Well, NVIDIA, they make chips. You say, yeah, but they make chips. What about the programmers? Okay, well, that would be Microsoft, ChatGPT. Okay, what about the companies that are incorporating it in production? The users, right? Well, I could name a whole bunch, like Symbotic, ticker SYM, that is robotizing, automating all of Walmart's distribution facilities. So, you start with that top down theme, artificial intelligence, and then you start poking around for stocks bottoms up and what are the best ones from a company level. And I think you meet somewhere in the middle. I think that's just a balanced approach.
And how many names do you have in the portfolio? And is there a minimum market cap that you look for?
I don't have a minimum market cap, although as a result of interest rates going up, larger is generally better because smaller companies, need access to cheap capital. And there've just been some wonderful, wonderful, but small companies that didn't yet have earnings that I just had to cut. So I've definitely moved up on the quality curve. So in the Bullseye newsletter, I currently have 44 that I track. And of those 44, 35 have made it into the actively managed portfolio. And the reason they're different is that, I publish the newsletter every single Sunday morning. And every newsletter has a pick, 7 a.m., sign up, find out what I like this week and why, and what I think it's worth. And, I just take you through the whole analysis the way a hedge fund analyst would take his portfolio or her portfolio manager through the analysis. That's what I try to do for the subscribers, take that kind of research and make it simple and straightforward. And so I always like to have a couple of picks waiting in the wings so that if one of my names that's in the actively managed portfolio hits the target and I sell half, as I always do because that's risk management 101, and then I have capital, well, then I have a few names over here where I can say, all right, of the 8 that are sort of waiting in the wings, which do I like this week that I can start shifting into. So that's why I always have more on the Bullseye side than I do on the actively managed side.
And of the 44 names you track, will they fall under this theme that you are trying to leverage, or will they encompass other sectors such as financials or commodities?
No, they will always fall under one of my specific investment themes, not a sector. I do very little in commodities. In fact, the only oil position I have right now out of all 44, and it isn't even quite a position yet because it hasn't dropped under 15, is Energy Transfer, which is the largest pipeline operator in the U.S. 40% of the nation's crude, 30% of the nation's product supply, and actually 20% of the world's natural gas liquids, or NGLs. 90% of their revenues are fee-based. They're a toll collector, right? They're not drilling for oil, they're just moving oil in pipelines and processing it and putting it in storage tanks and collecting fees for doing that. So it's very stable, ratable income. Only 10% varies with the price of crude or natural gas or NGLs. And I'll buy that under $15. It pays an 8% dividend, which certainly gets my attention. It's an LP, so not all institutional investors can buy a limited partnership, which is why it trades so cheap. 9.5, 10 times earnings, again with that 8% yield. But because it's a cyclical name, it's not a growth name. I mean, they're growing, but they're growing by acquisition. It's not like they're going to be, they're not going to grow their earnings by 50, 60, 70% as Nvidia will this year. They'll grow, 5 or 6%. So it trades at a whole different multiple, and you have to be very price sensitive. That's the only energy name I have in the portfolio right now. Everything else is slanted more towards tech or industrials or just, cool companies doing cool things with technology in their businesses.
So one of your big themes is artificial intelligence, and I want to spend a little bit of time here. And of course, NVIDIA is the go-to name that everybody talks about. Is this a name that you're currently invested in?
Yeah.
And maybe you can also touch on some other names that would fall under this category.
Sure. So, well, just because it's easier, I can't wrap my head around the recent 10-for-1 split on Nvidia. So we'll talk the old price terms, right? I bought it at I highlighted it for my subscribers at 175 2 years ago. Went up to 1,200 and change. But my first target was 475. I sold a little. Next target 675. Sold a little. Next target 900. Sold a little. Next target 1,200. Sold a little. My current target is 1575, or I guess now that it has split 10-for-1, that would be 157. We'll call it 160. And here's what's so amazing about NVIDIA. Yes, the stock has run up dramatically, but so have the earnings. 4 years ago, the company earned $2. This year, they'll earn $30, right? I mean, it's like 350% growth annually for 4 years. That won't last forever. I think it'll slow. And so I'm saying for next year, they'll earn $45. Again, this is just to make the math easy before the 10-for-1 split. So if you put a 35 multiple PE ratio, which is where Microsoft trades, on $45 of earnings for next year, that gets you to 1575. Call it 1600, or again, 10-for-1 split. What is that? $16. I mean, it's hard to think in terms of 10-for-1 split when I've been thinking the other way. So that's how I get to my current target of 160, and I'll sell some more when it gets there. The reason being that if I start off with a 3% position and it doubles, now it's a 6% position, all else being equal, doubles again, now it's a 12% position, doubles again, now it's a 24, right? And it becomes just too big in the portfolio. So you have to sell as a responsible portfolio manager. You have to sell a name that grows that quickly. Any name, whether it's growing quickly or just one that grows slowly but does get bigger and out of proportion, because you never want to have too much of your client's money in one name. So yes, I continue to love NVIDIA, even though I have been selling it. And then you ask me, yeah, but what if somebody new comes in and is buying it up here? Fine, I'll buy a 3% position. So that's how I deal with NVIDIA and growth. And yeah, gosh, there are a ton of other AI names we could talk about if you want to.
A couple of things I want to ask you about. First of all, what weighting? What's your maximum weighting in the portfolio for one name?
So everything goes into the portfolio at somewhere between 2 and 4% of capital at cost. At cost, that's important. So the day that I buy it, it's a maximum 4%, and the of the portfolio. So if I have $100 to put in, no more than $4 will go into one stock. Again, we'll make the math easy. I don't think anyone invests just $100, but make the math easy. I guess you could say 100,000 and 4,000, but and the smaller ones would be at 2%. And that is a lesson learned along the way. In other words, you can't weight um, Microsoft the same as you would a little biotechnology stock that no one's ever heard of, right? I mean, the biotech's risky. It may or may not ever work. I mean, arguably, maybe you should only have a 1% position. But I feel like if you're not willing to put 2% of your capital into a name, then, come on, what's the point? So 2 to 4%, everything's weighted 2 to 4%.
And Adam, you were talking about Nvidia and the valuations and how you think it's still pretty good value, but it's up over 150% on the year, and we're only 6 months into the year. Market cap's around 3 trillion now, give or take, and 2 trillion of that has come in the last 6 months. You don't think this is rather excessive?
Look at the earnings growth, right? I mean, they'll probably do $30 this year. And, last year, what was it? It was less than half that. It was, I don't know, 10, 11, $12. The year before that, it was what, $4. The year before that, it was $2. I mean, think of that. In 4 years to go from $2 to $30, of course the stock is up. In fact, arguably, the stock has not gone up as fast as the earnings. So the multiple has actually compressed. It's gotten cheaper over time. That's what's so amazing. I'm not going to tell you it's cheap now because it's not, but I do think it's reasonably priced. Again, if they earn $45 next year, again, 30 this year, I think they'll earn 45 next year. That's only 50% growth. This past year, they've grown 225%. All right. So I'm allowing for slowing growth. So if they earn $45 next year and I apply a 35 PE, which is the same as Microsoft, that gets us to almost $1,600. The stock is $1,200, or I should say 120 and 160 post split.
Nvidia, they make chips, okay, or they design chips and they have somebody else make them. But the whole chip industry is just another commodity, right? So it's just a matter of time before other entrants can compete at the same level that Nvidia does. Is this not a concern?
Yes and no. The architecture of the NVIDIA chip is completely different, which is why everybody wants them. So the speed of a chip is measured at this point in terms of what's called a petaflop. You say, the heck is a petaflop? A petaflop is 1 trillion calculations per second. NVIDIA's chips perform 60 petaflops. So, excuse me, 60 trillion calculations per second. That is like 61 million 1 millions. We can't even fathom numbers that are that big. To put that in perspective, that is 10 times faster than last year's NVIDIA chip, and it's about 20 to 30 times faster than AMD's chip. Even more importantly, the new NVIDIA chip, which is called Blackwell, is 25 times more efficient. It uses only 4% of the electricity of the previous chip from last year. Okay, so not only is it 10 times faster, it's 25 times more efficient. No other chip company can do that. And that is why NVIDIA's chips are not commoditized. They are unique. It's like saying, well, isn't, all orthopedic surgery just commoditized? No, because some orthopedic surgeons are better than others, which is why there's a long list for them and they charge more. And those particular ones oftentimes don't take insurance. So not all chips are created equal. NVIDIA's chips are certainly not equal to any others. Everyone's trying to be NVIDIA, including AMD, which, by the way, trades at a higher multiple than AMD. Why would you pay more for a company that produces inferior chips? So, no, NVIDIA is the one to own. Always go best in breed.
And if there was one risk to your whole growth assumption on Nvidia, what would it be?
Well, that demand suddenly slows down, that people realize maybe AI is going to take longer than we thought, and so we can't justify spending as much. So we're going to pare back our purchases of AI-related equipment, from NVIDIA chips to systems created by Supermicro to database chips created by Marvell, etc. If the CapEx, capital expenditure, growth curve slows, then that would have a negative impact on chip sales and therefore Nvidia's growth rate and therefore Nvidia's stock price.
And what about the fact that the chips are manufactured by Taiwan Semiconductor in Taiwan? What about geopolitical risk?
Yeah, the worst case scenario is the Chinese say we're taking over. Um, I guess that's certainly possible. Here's another worst case for you. Vladimir Putin drops a dirty bomb or a nuclear bomb on Kyiv. Yeah, I guess that's possible. Or Iran does the same thing. Yep, I guess that's possible. Or pro-Palestinian terrorists detonate a bomb in the basement of the Capitol. Yep, absolutely possible. The world is full of geopolitical risks that we can't possibly quantify. And if we thought about all of them, we'd never put a dime to work. In fact, we probably wouldn't even buy US treasuries because we'd say, well, what if Donald Trump is elected president and then he's put in jail? Yep, I guess that's possible too. There are a million reasons not to invest.
Yeah, but those events that you just mentioned would have no impact on Nvidia directly.
No, but they'd certainly have an impact on the market. And if the market went down, our beloved NVIDIA would go down too.
One of the things that I found interesting, Adam, I read in one of your newsletters that in Q1, 40% of all S&P companies mentioned AI in their Q1 press releases. And I guess when I hear this, I'm wondering, like, everybody's trying to capitalize on this whole AI theme, right? Do you not think it's becoming more of a fad now? Much in the same way that NFTs or the metaverse was 2 years ago.
Well, the difference is that NFTs don't make money for you, whereas I think artificial intelligence does, right? You think about the applications where you can increase productivity. Sorry to say this, but fire half your contracts department, high paid lawyers, because you can have artificial intelligence go through and proof contracts much more efficiently than lawyers can. There have been a number of studies to that effect. That's just one example. Think about the cloud. Think how the cloud has transformed the way information is processed. Absolutely amazing. Just think of actually how it's transformed Microsoft. Microsoft was basically the guts of the PC. And then along came the cloud, and Satya Nadella, the then new CEO, now well ensconced CEO of Microsoft, said, hang on, we need to reinvent ourselves. And the way we're going to do that is we're just, in the same way that we were the guts of the PC, we're going to be the guts of the cloud. And so they took the same principles behind managing the software of a unique PC that was a standalone entity and applied that to the cloud, and just distributed it more efficiently and more effectively. And they increased the size of their business manyfold. It's one reason why Microsoft now trades at a 35 multiple, whereas it used to trade at like a 15 multiple. Look at Cisco, stuck down 15 times, or Oracle, 12 times, right? Maybe I probably ought to look at Oracle now that I think about it. Maybe that's a new bullseye pick. Cisco, probably not. Oracle, because it's software, maybe. So, you have to think about transformational technologies. Look at e-commerce. Every company had to figure out how to become an e-commerce company back in, 05, 06, 07, 08. And then thank goodness they did, because by the time COVID came around, that's what kept the world afloat. So e-commerce was a thing. It's still a thing. It's still growing. 16% of all retail sales are now online, and that number grows by about 1% a year, 1 percentage point, I should say. So 16 becomes 17, becomes 18, becomes 19, et cetera. So in the same way that every company had to become an e-commerce company, every company had to become a cloud company, then every company had to become a data analytics company and to drive sales. And now that data analytics, you take that to the next logical step, is becoming predictive analytics, which is made possible by artificial intelligence. A Boeing airplane is flying through the air, and the GE engine sensors sense something that isn't working as it should be. It sends a message to the maintenance group at the destination, so that when the plane lands, the maintenance crew is already ready to go out to the aircraft as the baggage is being unloaded, and go to that sensor and figure out what happened. And they have the parts on site so that if they need to swap something in, they can do so, and that airplane is not late for the next flight. I mean, stuff like that, right? That's really powerful.
And Adam, what other sectors do you like besides AI?
Well, I don't think of AI as a sector because that's a theme across sectors. Um, but we've already talked about robotics, um, and think of all the companies. Plain old Honeywell. What Honeywell is doing with robotics is absolutely amazing. Automating its factories. Tesla. You probably ought to think of Tesla as a robotics company. In fact, my guess is that I don't own Tesla. I never have. I think of it as a cult stock, and at the moment, 95% of revenues are from cars, and I don't think EVs are actually that compelling. Um, so I don't own it. But that other 5% of revenues, making robots that they sell to other people, and storage entities, big batteries. They have all kinds of fancy names for it, but basically just really big batteries that mount on walls, or that are assembled in arrays and used by utility companies. Uh, that's the stuff I think that makes Tesla interesting. It's not cars. And so there are just all sorts of industrial companies that are using robotics in and robotics and AI are kind of related, because a lot of times the AI enables the robots. I mean, John Deere now has this ingenious device. Device is the wrong word. Device is too small. This ingenious attachment that is pulled by one of the big agri tractors that is 20 feet across, and it has a ton of little sensors back and forth, and it can identify weeds as the tractor is passing it up to 3 miles an hour. And then a laser, as soon as the 3D cameras see a weed down there mixed in amongst the corn, a laser goes and zaps the weed. And so as you're watching this thing out in the field, you see all these little blue lights as it's driving through the field, right? It's zapping weeds at 3 miles an hour. I mean, that's really cool stuff. So, um, there's a great example of AI and to a certain extent robotics working together at a good old industrial company, John Deere. Talk about American ingenuity. So I love finding ideas like that. John Deere is not a current Bullseye pick, but it could become one.
And I'm curious about what you said about EVs, especially given that you're trying to jump on these themes. And we've had massive growth in 2020. There was 3 million EVs sold globally. This year they're projecting, I believe it's 16 million, give or take. That's not the type of growth you want.
It's been a disaster. Everything I've done in clean energy has been a total disaster. I mean, I've lost money on virtually everything. The only quasi clean energy name I have currently is Aptiv, APTV, which is a spin out of the old Delphi Technologies, which is classic Detroit auto parts company. What distinguishes Aptiv is that it specializes on the electronic chassis that sits atop an actual metal chassis for cars and trucks. And not only are they number one for EVs, but they're number one for good old internal combustion engine vehicles as well, because they're now up to, believe it or not, 3,600 semiconductors and sensors on every car made. Not EVs, just good old fashioned gasoline powered, 3,600. So the electronic chassis or overlay that you need to coordinate all those systems is staggering. That's what Aptiv does. And growing dramatically, they supply every car producer in the world. They're really the go to. And that whole business has really taken off. That's the only, and it's not really clean energy, it's just electronics. It's American ingenuity, right? I mean, it's electronics business, which you could argue is a play on EVs. But the problem with clean energy is that it depends upon subsidies, and it used to depend upon low rates. In other words, very few of these companies actually make money, or very few of them are profitable to an extent that you can be proud of the company. They're young companies, and so they need cheap money, low interest rates, and they need government subsidies to be competitive. Well, that business model doesn't really work, right? Rates started to go up, and all of a sudden they lost their access to cheap capital. And government subsidies, well, that's just the government handing out money that we don't have anyway, that's just incurring more debt, and that's not a very prudent business model. So you sort of, as an analyst like me, you say to yourself, well, that's not sustainable. That doesn't work. So everything I've done in clean energy has been a total disaster, from solar to EV stocks to autonomous sort of. I never really bought into autonomy. Autonomy works in a controlled setting like a warehouse where you're talking about forklifts. It doesn't work on a road where you're talking about people who've been drinking or suddenly you know someone gets dizzy and crosses a line, or whatever. There are just too many variables out on a road. Warehouse, fine, but not on the road. So autonomy is a market, but it's a limited market. Clean energy, oh my gosh, what a disaster! Every single clean energy stock I owned, just poof. And I held on to them way too long. I lost 50, 60%. And I kept saying, yeah, but I mean, this thing could, it could really be great. No, it's a heartbreak hotel. Just sell it. Lesson learned. Not everything. I've outperformed the market significantly. And I would have outperformed even more significantly had it not been for clean energy. But we learn these lessons. Sometimes we need to relearn them.
And have you done any work on nuclear energy?
No, I haven't. That's a niche market, and it's really hard to put into a portfolio. I mean, I guess you could buy Nextera or Duke or Southern Company, but those are utilities, and they grow at what, 3-4%. That's not that compelling. Okay, yeah, I guess I could go buy uranium, but again, that gets back to oil. Uranium miners would be price takers, not price makers. And I know that there have been some people who've highlighted uranium makers or miners, and they've done very well. God bless them. That's great. Um, that's just not what I do.
So let's talk about cryptocurrencies now, because once again, this has been a very significant theme we've seen here in the last few years. What are your thoughts on cryptocurrencies and maybe more specifically Bitcoin?
Yeah. Well, I'm a believer, but I'm not an owner, which probably means I'm not that big a believer, except I own Coinbase and have for a long time. And I'm thrilled with Coinbase. I also own Square or Block, if you prefer, for some related reasons. When you talk cryptocurrencies, I think you have to talk about two different sides of that coin. You have to talk about the processing coin side of the coin, which is blockchain, right? The protocols that enable cryptocurrencies to transact, and then you can talk about the cryptocurrency itself, like Bitcoin or Ether or Ripple or whatever. I think we spend far too much time talking about the price. People talk about Bitcoin, and what they're really saying is, should I buy it here at 71,000, or is it a short? That to me is like uh, redesigning your house and saying, we're going to redo all the bathrooms, and do we want the shiny nickel hardware, or do we want the oil rub bronze? Oh my gosh, nickel, bronze, nickel, bronze. That's what you see. What you really should be talking about is the plumbing behind the tile. And the plumbing is the Bitcoin, or is the blockchain. And that's far more interesting to me than the shiny glitzy stuff that's on the outside that we can, sort of see. But the real value is the plumbing. And I'll give you an example of why. XRP, Ripple, was originally intended as an institutional way of moving money much more efficiently. So let's say the Bank of Mitsubishi in Tokyo wants to transfer $100 million worth of yen from its Tokyo branch to the New York branch, again, on behalf of a client. Well, it needs $100 million worth of yen in Japan, and it needs $100 million worth of dollars in New York. So it's tying up $200 million of capital. If in fact you were able to just attach the transfer to a token, it happens instantaneously, and you free up $100 million worth of the capital. You don't need to tie up the capital, and again, it happens instantly. So there's no worry about interest due overnight, etc. It's much more efficient. That is, I think, why Jamie Dimon of J.P. Morgan, even though he hates Bitcoin, is still willing to embrace the concept of cryptocurrency. It's about transferring money more efficiently. And yes, I do own Coinbase. And yes, Coinbase, even though it's kind of hard to build a revenue and therefore earnings model around it, because are they taking commissions, and if so, is that dependent upon the price um, of cryptocurrencies? The answer is yes and yes. Or are they starting to build out a business model where they serve as a prime broker? The answer to that is yes, and that's more reliable. In fact, if you are a BlackRock client anywhere in the world and you want to trade crypto, you're on the Coinbase infrastructure system. So it has become ingrained and institutionalized, whether people realize that or not. Again, the Coinbase platform has become ingrained. Um, for BlackRock, a very conservative and largest money manager in the world, to adopt the Coinbase system, that's a pretty powerful endorsement. So yes, the answer. I've given you a very long answer, but yes, the answer to your cryptocurrency question. I like it, and I'm invested in it, even if narrowly.
So let's talk about the economy now. And this move that we've seen in the S&P and the Nasdaq this year, it's all predicated on a cut in rates. And we recently got a revision in Q1 GDP, came in at 1.3%. That's down from 1.6% this time last year. I believe we were tracking around 3%. So we're seeing the economy slowing down somewhat. What's your take on this? And maybe you can also give us your view on where interest rates are going.
Yeah, sure. So I'll start with GDP. The long-term average, like a 50-year average, is 2.7% growth per year. So we appear to have slipped somewhat below that. It's kind of hard to know because a lot of these measures are retroactive, and they move around, right? The Atlanta Now GDP forecast to be downgraded from 4.2 to 1.8 over 3 weeks. You say, that's crazy. Yeah, it means no one really knows. If the Atlanta Fed is that volatile over 3 weeks in their estimates, no one really knows. So it's a best guess. Sorry, it's a best guess. Um, but the economy is growing. Look at employment, number one, uh, which is still very strong, even if there's some signs that it has um, uh, given a little bit of ground, ceded a little ground, right? The top line rate went to 4%, up from a low of 3.4, call it a year ago. But we're still creating over 200,000 jobs per month. And those two surveys that calculate, the headline number and then the jobs created number, they're different. So again, there's a little bit of slippage, but I think the takeaway is employment is still very strong. 4% is still a very strong number, and we're creating jobs every month. Fine. If we're creating jobs every month, that means that people have money and they are spending it. And since 2/3 of our economy, or GDP, is consumer driven, that bodes well for earnings, which is why earnings are growing 7, 8, 9%. If you have earnings that are growing, you can justify owning stocks. Now, just a quick beat on that for a moment. So if the S&P 500 companies collectively earn $250 in earnings this year, and that's a tad above the estimate. I think the estimate's 245, but I'll make it 250. And you say, given where the S&P is trading right now, that's a PE ratio of about 21 times. And even I, the optimist, the bull, will admit that 21 times is sort of the upper bound. Typically you see sort of 17 times to 20 times. So you start getting up to 21 times and you say, oh, that's the upper bound of where you kind of expect the market to trade. Now, if earnings keep going up, fine. So if earnings actually go to 260, well, that 21 comes down to 20.7 or whatever. But it's just something. It's in the back of my mind. It's why I don't blindly buy the market. I buy stocks within the market, and yet you always still have to have kind of a sense of where the guardrails, 17 to 20, 17 to 20. All right, we're 21. It's getting up there. So that's my view on the economy and sort of valuation. The other component, part of your question, was interest rates. And interest rates, I do think, will fall over time for a couple of reasons. Number one, inflation appears to be abating. It's a little higher than we thought. But if you look at the average of the four primary indicators, CPI, consumer prices, PPI, producer prices, PCE, personal consumption expenditures, and the GDP price index, you average all four together, it's 2.8%. 2.8. The Fed's target is 2. And as a reminder, CPI got as high as 9.1 and PPI got up to 11.8, almost 12. So again, the average is down to 2.8, the Fed's target's 2. So the last mile is proving difficult. That's because of housing and wages. But we're getting there. And I would make the argument that in case the Fed needs to, somewhere down the road, actually raise rates again because inflation reaccelerates, they'd be well served by just taking back a couple of the more recent hikes, so cut one or two or maybe three times, and then they bring rates down a little bit to maybe 4.75, so that if down the road they need to raise them again, they can do so, but they're just going back to where they were. I think it gives them wiggle room. And they can take back a couple of those hikes because inflation has come down again from 9 to 12% to, that 2.8 average that I've talked about. So I think we spend way too much time worrying about the Fed, talking about the Fed, the great rate debate. If you're buying stocks only because you think that rates are coming down, you're probably not paying attention to the stocks and the earnings and the fundamentals of that company. I appreciate the macro, the big picture stuff, but as a stock picker, I think we need to focus more on stocks than the macro. Have an opinion about the macro, understand the macro and how it impacts your stocks, but don't buy stocks just because the Fed's going to cut, or short stocks because the Fed's not going to cut. That's what Chicago traders do who are trying to make $1 over the course of 90 minutes. And it's certainly not what thoughtful long-term investors like me, like us, do to build wealth over time.
So just to summarize your comments on the economy, it sounds like you don't see any threat of a recession.
No. And I've been saying that for a long time. In fact, a year ago, people thought that I was this crazy optimist. They said, "Oh, Adam, you never see recession. You're so positive." Yeah, I am, because the fundamentals of the economy are strong. So a year ago, I said no recession. If you remember, when everybody did, 55% of economists said it was a foregone conclusion. Same thing happened in 2018. If you remember, everyone was so certain there was going to be a recession. And then the stock market bottomed on December 24th, again, 2018. We came in on the morning of the 26th. It took off. Powell said he was thinking about cutting rates. And by March, the S&P was up 35%. And everyone said, "Oh my gosh, there was no recession. How do we miss it?" People get so negative. The pendulum always swings too far. It swung too far in 2018. It has swung too far over the past year. My only concern is people don't get too positive now, because when everyone's positive, that's when you get a problem. But fortunately, there's still 6.1 trillion of cash on the sidelines, which is the highest ever. And when expressed as a percentage of investable assets at 23%, that's the highest in 10 years. So by each of those two measures, actual cash or as a percentage of investable assets, there's still a lot of skepticism, which is good, because skepticism means there are people who are not yet drunk with enthusiasm. In other words, what we saw in the tech.com bubble of 2000 is nowhere near what we're seeing now. And nor with NVIDIA as well, as we've just proven, given the earnings and multiple.
So I mentioned at the onset that you were a former oil trader, and I'm curious to hear your thoughts on oil, just given how important it is to the overall economy. It's been trading in this range of $70 to $80 a barrel. What's your take? Does it go higher or lower from here?
Well, absent war, I think oil would be trading in the 60s. I think there is a $10 or $15 war premium that's been built in. And what's sort of interesting to me is that OPEC is talking about rate cuts. We got that on the brain. They're talking about giving back the production cuts. In other words, increasing production. I can't figure out why they're doing that unless they have run the numbers and they see some sort of price elasticity of demand, and they say, which is opposite of what they've always said. Oh, if we increase production, the price will fall, but we'll sell more oil. They have never, ever, ever subscribed to that notion. So it's kind of weird to me that they want to increase production right now, which is why oil has backed off. A few weeks ago, oil was in the 80s, and now it's in the 70s. In fact, it got as low as $70 last week. So I haven't quite figured out the answer to OPEC, but then again, um, you know, that's a whole different mentality, right? That they espouse. I'm a free markets guy. They're the polar opposite of that. The U.S. is producing more oil than it ever has, which is ironic because the Biden administration has restricted drilling on federal land. We'd be producing even more if not for that, and the price would be lower, by the way. Um, just a function of greater supply. But when you have the U.S. producing the most ever, the Saudis producing the most ever, embargoed Russian oil finding its way onto the market through the back door because everyone realized, oh, Europe actually really needs the oil. So even though we don't want to support Vladimir Putin, we need his oil, fine. So they have figured out backdoor ways to get Russian oil, embargoed Russian oil to Europe. Shh, don't tell anyone. Ditto Iran. Well, they're really not such bad people. And since we don't want U.S. drillers drilling oil, these are the people at the White House saying, not in my backyard. Let's let the Iranians quietly bring some more oil onto the market. They're not such bad people. I mean, they haven't actually made a nuclear bomb yet, right? I'm being a little sarcastic, but there's some weird things happening in the oil industry right now where Russia, um, Iran, and even, Venezuela, Maduro. Oh, if you have elections, we'll let you pump again. Shh, don't tell anybody those elections aren't really free. They've since jailed two of the opposition candidates. Shh, but no, they're having elections. Not in my backyard. We'd rather have Venezuela pump than good old American producers. Again, I'm being sarcastic. But I have some views on oil. I think the Biden administration is being incredibly disingenuous in its policies. Drill, baby, drill. Let U.S. producers do what they do best, which is to innovate and find oil in impossible places. Get to it with fracking, link it by horizontal drilling underground, bring it up to pads where you then have pipelines that can take it away and get it to market. This is what we need to do. Oil would be cheaper if we did.
Yes, I will say I think oil of all the commodities is probably the most interesting just because of the geopolitical elements. But what about a slowing economy? Do you think the economy could be slowing at a much faster rate, and therefore that's why the oil price is lower? And maybe not just in the U.S., but in China and the rest of the world.
You know, there was a lot of talk when about a week and a half ago, the ISM manufacturing data came in weaker than expected. Um, and and then a couple days later, the ISM services came in much stronger than expected. And there was concern that, oh, wait a minute, maybe jobs in the economy are pivoting away from manufacturing. You know, that's 1 month's data. And we seem to be lurching at the moment um, from one piece of data to the next piece of data. And the futures, especially you see it in the bond market, just slide from one extreme to another based upon one piece of data that uh, tries to identify what was happening with one component of the economy. Unfortunately, the downside of transparency and instantaneous information brought to us by Twitter and you know the internet, etc., is that suddenly now everyone is an expert. Right? Remember during COVID, everyone was suddenly an expert on infectious disease, or during bird flu, everyone is suddenly an avian scientist, and everyone has an opinion and wants to share it. And so we see one piece of data, and then say, "Oh, see, there it is. I told you so." I would say, step back. It's like my old boss used to say, "Hang on, sit back, smoke the pipe, stroke the dog. Let's talk about this. What's going on here, right?" Um, and I think if you look at the data in its totality, um, you can find any story you like, slowing, growing. But the bottom line is we are still growing. And if we're still growing, and you have, again, economic growth, call it the three E's: the economy, earnings, and employment. We have all three. We have all three of the three E's right now. And by the way, they're in growth mode. So it's hard to get too negative when you have the three E's growing simultaneously. Um, we could argue about whether it's slowing or accelerating, but they are growing simultaneously. We also have a situation where inflation has come way down. It's not where we want it. The world is not perfect. But we probably also, as a result of that slowing inflation, um, have a Fed that will at some point cut rates. So again, the three E's: earnings, employment, the economy, slowing inflation, and at some point lower rates. I think that is an attractive backdrop for stock pickers. You don't buy the whole market, you find outstanding companies, right? The people, companies, and technologies driving the world forward. That's American ingenuity. And you find the best names, the best companies across multiple sectors that are supported by powerful themes like artificial intelligence, and you deploy capital. That's what I do for my subscribers. It's what I do for my money management clients.
Well, Adam, that was a great discussion, and I want to thank you very much for spending time with us today. If someone would like to learn more about you or hear your thoughts about the markets and the economy, where can they go?
Oh gosh. Well, first of all, thank you, Jimmy. It's a pleasure to be able to have a conversation like this in long form and not be rushed. So thank you for making time. Um, bullseyebrief.com. That's where you can find me. I publish every Sunday morning at 7 a.m. a new stock pick every week, plus news and catalysts on our stocks, as well as relevant trades. I absolutely love what I do. It's a pleasure for me to be able to do this and to share the knowledge with everyone. And by the way, I have a 45-day trial for $45. So I try to make it easy for people to come on board, get to know me, get to know my process, get to know American Ingenuity, and then ultimately become long-term subscribers where we grow together and build wealth for our families.
Well, Adam, once again, thank you.
Oh, thanks, Jimmy.
Well, I hope you enjoyed that discussion with Adam Johnson, and it gave you some insights on what to expect from both the economy and the markets in the coming months. During times of economic uncertainty and high inflation like we're experiencing right now, physical gold is one way to protect your portfolio against the constant erosion of inflation. If you would like to learn more about gold and how it can benefit your portfolio, visit our sister company, hardassets.alliance.com. Hard Assets Alliance is a trusted platform that is used by over 100,000 institutional and retail investors to buy and sell gold bullion and gold coins. Once again, that's hardassets.alliance.com. I want to thank you very much for spending time with us today, and I look forward to seeing you again soon.